Hello, everyone. My name is William Mucker. I am a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar. Outside of the real estate box, investing above average returns from cash flowing niches with Jamie Kinzer, VP of Investor Relations with ALG Holdings. As a quick note, please be aware that Jamie will be answering questions at the end of the presentation. However, feel free to use the Q&A function on your screen, not the chat, to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of that dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information provided today have any questions about today's presentation and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'd like to pass it over to you, Jamie.
Hi, everyone. Thank you for jumping on board with us today. And I'm excited to talk about what we're doing over here, because I think we're a little unusual. And also really want to thank Camaplan on the real estate side of our company, Freaky Fast Home Buyers and Investments. We've been working with Camaplan for years and have several clients already that are with us. Maybe some of you are even on today. I didn't even read the whole attendee list, but just thank you to everybody involved. And I'm excited to get going here. Let me share my screen. So here we go. Will, be sure to let me know if I'm messing up here on a technical side of things, if anything can't be seen.
Everything looks good on my end.
All right, great. So here we go. So we're talking about out of the box type of investing. So one of the great things about an SD IRA is the ability to invest in these alternative investments with your IRA. Alternative investments frequently have higher returns than we're talking about the double-digit type returns. So it's perfect to be able to use these funds to get that kind of thing. So at ALG, I put Freaky Fast's logo here because some of you may be a little more familiar with Freaky Fast. We're not exactly sister companies, but we're all kind of in the same building here and share principles. So there's a third part to what we do as well called Crow Exploration. Now, Crow Exploration is an oil and gas operating company. So we aren't brokers that buy deals from other folks. We do the drilling ourselves, the testing ourselves. We're out there in the field every day. So here at ALG, these are our CEOs, these three goobers. We've got JB Yowell, the CEO of ALG, partners with Jason Engelman, the CEO of Freaky Fast Home Buyers and Investments, and then Crow Exploration, that's Brett Crow. And then here's a little bit more about what we're doing here. So we have ownership in a range of companies. So obviously Crow and Freaky Fast are part of that. And then we have Parati's Pizza, Perk Coffee, Hyenas Comedy Clubs. We've got a new pizza chain that we're starting here. We've got a variety of we have delis, more restaurants. We have a property management company. So we're doing a lot here. Now, all of these companies have, from an operational standpoint, excellent teams behind them. But at the partner level, we're all the same. So it's great for us to be able to work with investors to build these brands. And you know that once you've done something with Freaky Fast and you want to maybe look at an oil and gas type project, then we've got that. We can offer you too, and you don't have to really start from scratch doing due diligence. When you're investing, trust is everything. So I'm the VP of Investor Relations here. All I do all day, every day is talk with investors about their portfolios and other investments they're doing. And so I know that when you find a company where you like their communication and their trust, that's everything. So we feel like being able to offer diversification with all of our brands is one of our strengths and a service really that we can provide to investors. So that's a little bit about what we're doing here. And this is kind of you guys are going to read this slide, most of you, and go, duh, Jamie, we know what diversification is, but it's incredibly important. And so when you're able to lower your risk by not having all of your eggs in one basket, that's a big plus, essentially. And so, like I said, here we're uniquely positioned to offer diversification in real estate through Freaky Fast, in oil and gas, and then also in like private equity funds that we put together to grow the service and restaurant hospitality side of our brands, all within one trusted conglomerate of companies. So here's a little bit about the niche thing. So everybody knows, and I'm not exactly going to read this verbatim, but you guys certainly can while I talk. But everybody knows that investing in real estate is great, and that's a very important part of anyone's portfolio. Now, a lot of those are private equity type deals. So there's other things too that we're doing, such as investing in a pizza shop, comedy clubs, coffee. These are things that aren't typically discussed, but have huge upside potential. And what we're really doing here in our dream is, so we're acquisition entrepreneurs, and we've really noticed that this is a unique time in history where a lot of baby boomer type, their generation is retiring, and they spent their lives building these beautiful brands. We call them heritage brands, things where they're beloved in their communities, and people want to retire. They want to get like a pop on what they've built and get some money for selling their business, but also not see it go away after that or be absorbed by something big. So we're really big on buying a brand that has a great history, tons of potential, and keeping that brand. And with Hyenas and Crow and not Crow, well, yes, Crow, because we started it, but with Hyenas and Pirates and Perk, we keep the original owners kind of in our deals and let them retain a little percentage of ownership, and always want to preserve their legacy, essentially. So our goal is to just keep doing this and growing the brands that we find and we believe in, and that provides a lot of opportunity for us and then you guys as well. So here's what we're doing on the real estate side of things. Now, you guys are a lot maybe familiar with us, maybe we're not, but Freaky Fast focuses on long-term and short-term rentals. So we're a turnkey provider. We find them, we rehab them ourselves, we do the property management ourselves, and we make it really passive for the investor. So we found that what we do over here is we like to keep it lower. It's lower risk because you either have ownership in properties or first lien position on properties in the case of our lending fund. The returns in Freaky Fast are really safe to say about 10 to 13%. Sometimes it can go up, but annually you're looking at a pretty safe bet right in there. We do monthly cash flow. We think that's really important for investors to be seeing something hit their accounts every month. And then our funds are available. We have these two on the right still open, and the starting positions are around 25K. So especially when you're working with a new company, it's important to be able to dip your toe in the water and see what they're about before going in a little heavier. These are all perfect for IRAs. Like I said, we probably have maybe 10 or 15, I'm not certain the exact number of Camaplan folks currently in one or multiples of these funds. So Freaky Fast is something we're pretty proud of, and it's growing. Then oil and gas. So here's the thing about oil and gas investing is that it's got tremendous tax benefits, but that's, if you're using your IRA, that's not really applicable here. Though you can invest with your IRA, you just are able to only take advantage of more of the benefits of the actual returns rather than the tax benefits. So all that aside, oil and gas is interesting because it's the highest risk, because there's so many speculative variables. We have excellent scientists and professionals out in the field, but at the end of the day, nobody knows what's under the ground. There's things, really extended timelines with oil and gas. Sometimes there's, if you have to lay an extra line, it could take weeks and months to do, little things like that can really elevate the risk of oil and gas. That said, this is the way it works: higher risk, highest possible returns. So with Crow, on our producing wells, if you're looking at lifetime returns, it can be hundreds of % higher of your investment. And then annual average about 40 to 60% annually on producing wells. We pay out monthly. We think, again, that's really important. Oil and gas makes its money selling barrels of oil, or MCF, which is the abbreviation for M's for 1,000 and then cubic feet. And that's how you measure natural gas. So we pull all this stuff out of the ground and we sell it, and it creates monthly cash flow. Again, drilling projects can take unknown periods of time. So that's important to know. So that's what we're doing over here on the oil and gas side of things. It's also important to note that all three of our CEOs, Jason, JB, and Brett, all have a background in oil and gas. So we're very well versed in this, and certainly happy to answer any questions anybody has about this. Here's what we're doing on the ALG specific side of things. So we put together these private equity funds, they're alternative investments, and these are more, and when I say medium, high risk and returns, this is all relative to what we're doing within our company. But I think you'll find that it kind of reflects the bigger picture too. These are more medium, high risk. So there are speculative variables, such as the timelines that we think that certain businesses will achieve certain benchmarks of growth. However, it's also pretty safe because, for example, Parati's, you're looking at a pizza restaurant on a college campus that's been there since 1986. Our college kid's going to eat pizza. We're willing to bet on that. It's got high annual returns. So we're looking at 18% track record on our DTB fund, which was a lending fund we did last year, that helped us get to the point where we own a lot of these assets like Parati's and Perk. And then our newest thing, which is the diversification that we're excited to talk about today, is the Evergreen Diversification Fund. And these returns are around 23%. Again, monthly cash flow that comes in from the revenue of the businesses that are in this fund. And yeah, let's jump into the EDF because it's really cool. So, well, not directly. So yeah, I put this little slide here. So this is, important to know that alternative investments and private placements, one of the reasons that their returns are so high is because in general, they are riskier. They're held by private companies. And so we're not registered as far as the Securities and Exchange Commission having oversight. So we're not publicly traded. We certainly file everything. It's called a Reg D. You guys are probably all familiar with this, and I'm not blowing any minds here, but just to make sure that everybody understands. So it's missing some of the general protections, disclosures, and regular reporting that comes with the SEC oversight. Though at ALG Holdings, it's very important to us to get as close to that as we can, even though we're not technically obligated to. So we're completely transparent. We do weekly reports, we do monthly reports, and whether it's us or any other company that you're looking at working with, that's extremely important. That you've always got a good customer service person on the phone that you can call, that you're getting updated regularly. And again, like I said, we're big on the monthly statements. So, and then we have our little disclaimer at the bottom. So obviously this isn't an offer for a sale or anything. We're just kind of talking to you about the areas in the market and the opportunities that we've identified and share that with you guys. So here we go, this EDF. So what this allows you to do, we've taken cash flowing assets across all of these brands, Parati's and Hyenas, Comedy Club, Crow, oil and gas, Freaky Fast Real Estate, and we've put a little bit of everything in one fund. Now, in this, it's diversified against these verticals. When you invest in this, you get fractional ownership in all of those brands. Now, here's where people get pretty excited, and what's great about it is returns, right? That's ultimately what we're looking for. So the returns here are pretty high. So if you look at the yellow, our target is about 229% return over a 5-year period, because we're looking to, with the EDF, acquire these assets, hang on to them for 5 years, make monthly cash flow on the revenue they generate, and then sell them in 5 years. So pretty good numbers there. It's all very exciting. And I've got a good breakdown of how we got all these numbers and what each asset produces every month. But if you're interested in that, shoot me your email, phone number, and we can go over it. I can send you the actual deck. Here's a breakdown of what we've done with this. And so it's built specifically because of this uncertain economy. Everybody's talking about a recession. Are we going to have another pandemic lockdown? I mean, it's just unprecedented uncertainty in markets and in our society in general right now. So what we've done is, here's a little pie chart of the breakdown. We've got a couple of Airbnbs in this from Freaky Fast. These are short-term rentals. We've owned them for a couple of years. They are in a market. They're in Columbus, Georgia, which is very close to an Army base. So our Airbnbs are not particularly dependent on a lot of travel for vacations. They're more dependent on this big military base, which sustained us very strongly through pandemic lockdown. We had a lot of essential workers in our more long-term rentals and people visiting the Army base in our short terms. The Crow 3 well is going to be a project that we drilled beginning in 2020, finished it in 2021. It's 3 natural gas wells. We've got 2 of our pizza restaurants here and then 2 comedy club locations. I'm going to dig a little bit more into pizza and comedy in a minute and why those are so valuable. Again, this is backtrack. These are the Airbnbs. These are the names of them. If you screenshot these, look them up. You can just look them up on Airbnb and see how cute they are, read the reviews. But in general, we're looking at these produce cash flow every month, right? So if you're an owner of the EDF, we pay all the overhead with these, we take all the profit and we pay it to the EDF owners because that's how it works. This is a little bit more detail about the gas wells. In general, we're looking at an average of 400 MCF a day across all of them. Again, with oil and gas, it fluctuates a lot. So if one goes offline, that can drop considerably, or if they're all at max volume, it can go up. So unpredictable gas wells. However, what's interesting to note about this right now is that the #1 producer in the world for natural gas is Russia. And things aren't lovely over there right now. So anyway, domestic natural gas production is going to be increasingly important now and over the next few years. So the price of MCF hovers around 7 or 8. We're pretty certain that it could go up to, it's talked about, it could go up as much as 10. All of our figures in this fund and projections are based on $8 per MCF. Here's Parati's Pizza. So Parati's is one of these heritage brands that we love. It was founded on campus at Texas Christian University in 1986. And we bought it in early 2021. And it was just 2 locations or 1 location at the time. They had tried to open another one at one point. It didn't really succeed, but we saw this beloved brand. Everybody in Fort Worth knows Parati's Pizza. But there was just 1 location. And when you walked in, the interior was terrible. The online ordering system was bad. But it was just so beloved. So anyway, we acquired it. This was our first big project. We remodeled it. We redid the website, the online ordering system. It looks beautiful now. You can see in this picture, you've got great furniture in there. Now people actually come and sit down and eat. We increased what we pay all the employees. We got better products. And so it took us a little while to get this one cash flowing. We really wanted to make it the best we possibly could. And so now we've done it. We've got a formula and we are opening new locations. So this is, we have this location here on TCU campus. The second location that's in this is called Sycamore. That is in a very popular residential area in South Fort Worth. It's it's in between a Starbucks and a T-Mobile. We have a drive up. Before we even really publicly launched, we had people just knocking on the door, driving by the windows, knocking, that really excited for it. We've done very little marketing at this one so far, and it's already almost making as much as the TCU location. So it's pretty exciting there, and we know that's going to go up tremendously. Hyenas. So these are our comedy clubs. Hyenas was founded in 1993 in Dallas, Fort Worth, and the assets that we've got in here, the Fort Worth location is not in this. It's just ownership in the Dallas location and the Albuquerque location. I'm going to talk a little bit. So comedy is really cool. Now, I talk to investors all day long and they say, that sounds risky and crazy. And I've never been to a comedy show. And hopefully some of you have. But here's the math around why stand-up comedy is a great investment. First off, it's very important that you're working with someone that's been in the business a long time. Showbiz is about relationships. And so if somebody just said, hey, I'm going to start up a comedy club, that's not as good an investment as something that's been around since '93, for example. The founder of this, Randy Butler, is a legendary booker and promoter in the business, knows everyone in the world, started his career with Ellen DeGeneres and Tim Allen, regularly gets very big names. Now, the only reason that we don't necessarily get as big a names as something, say, like the Improv chain, is because we only have 2 of these. The third one, Albuquerque, which is part of this fund, is opening this summer. And once we have, and it's Randy Butler's dream, it's JB, our ALG CEO. It's also my dream too. About 10 years ago, I was a cocktail waitress in one of these clubs. So it's a very important brand to us. If we have 15 locations of this, we're bigger than the Improv, and we'll be the biggest comedy club chain in the country. And we have it all mapped out to get there. And we're going to get there by doing funds like this. So we're going to take these bar revenues that come in every night from, so here it is. You've got one performer that you have to pay, maybe 2 or 3, including the host, but they're not very expensive. You're doing 2 shows a night. You've got a showroom that's between 200 and 400 capacity. And every person that comes in has a 2-item minimum purchase in the showroom that's required. So this is really standard in comedy clubs. So when you start to crunch all those numbers and you've got an average $30 per person times this many people times this many shows, the revenues are exceptional. So it's not uncommon for Hyenas to be around $1 million sales every year. And so the Albuquerque location is, again, it's opening in June, but we know this one's going to perform well for a few reasons. It's the founder, Randy, is from Albuquerque. We have some really strong business partners there, such as like cast members from Breaking Bad, and again, relationships, right? And then also the city is very excited to have us there. So there's a new development there called the Winrock Town Center, and they've given us an exceptional deal on the space. So, and tons of promotional support. So Hyenas is really cool. And so comedy, again, not something a lot of people think of, but huge upside potential there. I put a couple articles here. So these are things that you might read and wonder how you could benefit from them. So here's an article from Barron's. This was last summer. This is about what types of restaurants will fare best in a recession. Think pizza and burgers, right? So this article is heavily about McDonald's, but it certainly mentions a few things like Domino's. Again, this is something, the link's at the bottom. I can put the link in the chat, but it's a quick Google to see these types of numbers. Pizza company shares are only down 15 when other ones are bigger. This is like, but yet the important things to note in gold. So it's likely due to the fact that we have greater resiliency in a recessionary environment, more stability in the cash flows, and thanks to their franchise models. Again, right now we only have 3 Pilates locations, but the goal with Pilates is to open at least 10 of them over the next 5 years. Here's another article, pizzerias thrive in slumping economy. So obviously this is a bit of an old article, but it's significant to note that it's right after the Great Recession. And if we anticipate that coming again, and you're thinking about investing in something, how is it going to fare if we have another recession? Right here, you can see pizzas do thrive. And the reason, it's such a cheap meal, a large pizza for a family of 4 is an easy indulgence. And then also, especially during the pandemic, we all know we weren't going out to eat. We were needing someone to do no contact delivery, spend $20, feed a family of 4, drop a pizza off on our front door. So we're betting big on pizza. Here's an article, and this is about the movies. So this is where it applies to comedy clubs. There's not a lot of data on comedy clubs, frankly, but from a price point, it's very similar to going to the movies. You're basically going to spend about the same amount of money. And the idea is that you're getting a kind of an escape from reality. You're laughing, you're having a drink, you're being around folks. And when times are tough, these are things people need. And so we do have an investor who actually owns a chain of movie theaters. And we've talked, he's in the EDF fund. We've talked with him long and hard about how similar comedy and movie theaters are. So this is an interesting article to read. And this one's so interesting, I actually made this one 2 slides. So yeah, here at the bottom, it says Americans just want to hide in a dark place, which that's a little bleak, but recessions are hard. But yeah, people want to forget their troubles. They want to be with other people. And then, you're going to see in a recession, vacation places are probably going to hurt. People aren't taking as many very big, expensive indulgences, but they still need something to keep their spirits up during these times. And you'll note this quote at the bottom: spending hundreds of dollars to take my kids to Disneyland is ridiculous right now, but for $60 and some candy, I can give them some fun. That applies to adults too. For $60, a couple of your friends, go to the comedy club, have some cocktails, laugh your butts off, really helps people. So again, this EDF fund was created to perform well in the event of a recession. Obviously, if we don't have one, everything's still performing great. This is a little bit more, this slide's about kind of our track record and some of the other funds that we've had open, the types of returns that we've done. Just want to show you guys that we're not totally spring chickens. We're a bit of a young company. All these brands around 4 to 5 years old. Experience level is definitely decades older than that, but this is what we've been doing since these entities have been formed. We saw these three folks up at the beginning, our CEOs. That's me down center. So that's Jamie. So just pretend I'm waving at you, and thank you for listening to me go on and on. But we've got a great team here around all of our employees, 60 to 80 people. We've got a great legal team. That's certainly very important. CPAs, third-party CPAs, all that good stuff. So that's basically it. We recognize here that there's ways of making money that are kind of outside of what people normally think about when they think about investing. And so we want to provide those opportunities to you guys and then help us kind of build our dreams over here too. So there's my card. And I'd love to answer any of the questions you guys have about these particular industries, verticals, or investing in them now, if anybody has any questions.
Perfect. Amazing presentation, Jamie. Thank you so much. A lot of information I never heard discussed before, and I'm trying to absorb it all right now. So as Jamie
said, I hope I wasn't talking too fast. I've had like 3 cups of coffee this morning. I'm a little jittery.
No, perfect pace, perfect pace. As Jamie said, please use the Q&A function for any questions you have. I love to get some of your questions in here. So we do have some questions coming in. One is from Paul. He asks, are the current investments in EDF fixed once you invest, or do you add and take away companies from the fund on a regular basis?
We are not planning to. So it's only possible if we find that for some reason something happens with one of the assets where it's going to dramatically underperform, we may consider replacing it. So hypothetically, if if a semi truck runs into our Sycamore Pilates locations and we have to shut down for 6 months or something, then we would probably take our third location in Colleyville and put that in the fund. That's a possibility. We always want to say that things can change, and all of our funds have a 220-page operating agreement that break all that down. But for the most part, the plan is just these assets. And we will be creating future funds. We're going to do the EDF 2.0 probably around the 3rd quarter for this year. And that's going to have some of our coffee shops up in New York in it, probably another couple pizza locations. And so it's fixed, but in the event something dramatic were to happen that would negatively affect our investors, we will amend.
Awesome. Thank you for bringing clarity to that. Next question we have is from Craig. It looks like it's a 2-parter. What is the monthly cash flow versus total return projections, and what is the investment's liquidity?
So in this fund, it's a 5-year hold, and we want to make sure that we have enough time to grow Pilates and Hyenas. The acquisition price of all of these assets is $4.4 million. That includes about $1 million for each of the Pilates locations. And all these valuations are based on EBITDA. So it's a metric for evaluating the price of businesses. I'm sure most of you know this. Earnings before interest, taxes, and deductions. So we are selling these assets to the Evergreen Fund for 3 times EBITDA. Because there's so few locations. And so in the next 5 years, our plan is to open 10 at least of each brand. At that point, they would be able to be sold for 6 to 10 times EBITDA, just due to the branding, more locations, more support. So that's the plan. So that's why it's important for us to hold these for 5 years. Now, the monthly cash flow versus total return is because this is an equity fund. You have equity in these businesses. You guys own the businesses, or you guys, the investors, own the businesses. So every month they make cash flow on the revenue that these assets produce. And that's what your monthly comes in at. And then at the end of 5 years, your principal is still tied up in the ownership of the businesses. So in 5 years, we sell the businesses. We have an excellent strategy for that already. And so the combined is going to be your total ROI, the sale price plus your monthly dividend check.
Thank you, Jamie. Next question. It seems like we have two people asking about minimums of investment minimums. Ron says, so most of the investments are 25,000, and another person is asking basically just what the minimums for the investments are.
So this would be a good point to pivot back a little bit to Freaky Fast. So, oh yeah, amortization. I thank you, Tom. I'm sorry, I see that popped up. I'm spitballing a little bit here because I'm kind of jittery, but yes, it's earnings before interest, taxes, depreciation, and amortization. I knew that was wrong when I said it, so thank you for clarifying. And that's also a very important metric that anybody that doesn't understand it should definitely Google that and read all of it. So jumping back over to the minimums and Freaky Fast. So our Freaky Fast funds are still open right now. So if this all seems like a little out there for you, or maybe you just have some room for a little more real estate, Freaky Fast is great. And so those minimums in those funds are 25,000 to get started. And then in the EDF, it's 50 for new investors. We allow smaller units for people that are already clients. Mostly that's just because we want to make sure that we're working with folks that can stay with us for a long time and help us grow. We'd rather have fewer, stronger investment partners than a whole bunch of smaller ones. I think that's pretty obvious. We all probably have those similar goals. The hold period, I'm sorry, I see Scott's question pop up here, so I'll just jump in and invest and answer that. So like I said, the hold period for this is 5 years, and then the exit strategy is selling the assets. So the only one of these assets that is most likely going to go down in value is the gas wells. Again, we don't know exactly. So they deplete. So over a 5-year period, these gas wells could deplete down to almost nothing, and then we could salvage all 3 of them for around $250,000. If they deplete a little bit, we believe that we could get about 500,000 for them. If they stay where they're at, 1.2. And that's, again, it's all broken down in the deck. We can explain that a little more, but really when you evaluate the value of a gas well, it's very similar to real estate. It's comps. The data is a little bit harder to find, but that's how you do the oil and gas wells. The Airbnbs in 5 years, those are going to, with the real estate market being what it is, likely the correction as far as home values has already started and will continue for a little while. We believe very strongly in 5 years, these are going to be worth more than they're worth now. They're beautiful historic homes in downtown Columbus, very strong renovations. So those will appreciate just like any other real estate. And then I mentioned, and I don't know if you heard this part about the having 10 locations and being able to sell the businesses for more, but the Hyenas and Pilates businesses for more. Hyenas, interestingly, so showbiz is kind of a small world, and anybody that's been involved in it really knows that. Hyenas has already been hit up about being purchased by multiple types of entertainment companies. Joe Rogan's a famous podcaster. He's got a company outside of Austin that has inquired if Hyenas was for sale. And this is already, not after we put a bunch of money and energy and effort into it over 5 years. 5 years from now, there's going to be a lot of interest in acquiring Hyenas. And so we're either going to sell it to one of those entertainment companies that's interested, but most likely, seeing as how we all love this brand so much and we're so dedicated to growing it, we'll most likely buy it back. And that would either be by way of a new entity, or even Butler Ivy Productions, which is the founder's company. He might want to buy them back, or we may even put them in a larger fund. And the same really goes for Pilates. It's our brand. We love it. We're going to grow it. And so we'll probably buy it back. But if there's a better offer, we're always going to take the best offer.
Amazing. Thank you for that. I see some questions coming in about your locations and where you're headquartered out of.
Yeah, so we put all these cities on here, and that's because we have kind of offices, we have employees, we have assets in all these areas. So we're based in DFW. That's where our headquarter office is. We have office and coffee shop locations in New York. We put Atlanta mostly because if we put Columbus, everybody would assume it was Ohio. And Columbus is very close to Atlanta. We do have a lot of employees in Atlanta, like property managers and stuff like that, for the real estate properties we have in Georgia. Nashville's the same. Freaky Fast was founded in Nashville. And so we've still got some boots on the ground there. Not a lot. We are kind of getting a little bit out of the Nashville area. And then Cincinnati's the same. We have properties and property managers there too. So yeah, we're kind of all over and we're growing. And also, since we have real estate in these areas, these are some of the other areas that we're discussing putting, we're looking at putting a hyenas in Atlanta or in Columbus. We're looking at a hyenas in Nashville, Cincinnati, a Prades, Nashville, things like that. So those are our core cities that we're working on right now.
Great.
Mhm.
Have a very far reach at this moment, huh?
Yeah, I mean, we've got a pretty big team, and we are all very ambitious, and we've got a lot of really great investor partners that have helped us and guided. We've got a lot of great mentors, and it's our ultimate goal. We would like to be able to be managing $1 billion worth of business assets eventually. I don't think we have a real big timeline on that. Probably about 10 years would be the dream there. But I think we're going to get there, based on what we've done over the last 3 years, we're on track.
It's a great goal to have. Any
Yeah.
more questions for Jamie while we have her? Jamie, are there any questions that usually you run across that you may not have heard today or may not have covered in your presentation by chance?
A lot of new investors to oil and gas is one of the things that I find a lot. There are so many ways to lose money in oil and gas, and it's scary. So just in general, I want to make sure that everybody knows that if you're looking at any type of oil and gas investment, whether it's within your IRA or outside of it, you can't do enough due diligence on the company. And then the most important thing is to make sure you're always working with an operator and not a broker. You really want to eliminate the middleman. There's broker dealers out there that find oil companies that are doing drilling, and they go and mark up their deals and sell them to people, and they make a bunch of money, and really it's at the cost of the investor. And so it's important to try to eliminate the middleman there. And so that's important to note. And then, again, just doing some research on how pizza and inexpensive entertainment performs during recessions, I think is important. I know we touched on that, but that's important. So it looks like there's maybe some more questions that popped up.
Yes. It looks like Paul was asking, do employees of your companies and also invest into your funds?
So not exactly. Our funds are available for accredited investors. So we do have on the real estate side of things some lending opportunities if you're not accredited. And then accredited, I'm sure you all know, again, I'll recap. It means that you've got the SEC's definition is that you make as an individual $200,000 a year, and you have for the last 2 years. You anticipate that in the coming year. If you're married, it's $300,000, and then or you can be accredited by net worth. So your net worth excluding your primary residence needs to be $1 million. So our funds are available for accredited investors. Our partners are certainly all, they're in deals. They're not everybody is in every deal, but we most likely, I'm not personally accredited yet. I'm very close, working at it every day, but I can't invest in these. So I'm a partner in the deals. You'll find all of my information in the operating agreements, and it goes for all the partners up here. But I think the answer is if we all could, we all would. And we are investing, maybe not with our dollars, but definitely in our time spent. And another way that we're all deeply invested in this company as our employees is that we're very much a family business here. So a quick note about ALG and Freaky Fast and Crow. We're all very close friends. So Jason Engelman and JB Yowell and I had a talk radio show for a few years a while back, and very close friends. Jill Howell is our internal fund administrator and kind of internal CFO. She's my younger sister. Our hospitality operations director is my brother-in-law, Adam. Our Thanksgiving table looks a heck of a lot like a business meeting, but I really feel like that is one of the strengths here. None of us are up here messing around. If any of us do anything, if any of us were to do anything irresponsible, it would directly impact the people we love the most in the world. We all like coming to work every day, and we're all really building something together. So we're all invested deeply in some way, to answer the question.
That's a great answer. Paul, thanks you for that.
Yeah.
I do as well. Craig asks, can I invest through an LLC? I believe you also touched on the cash flow in a prior question, but if you could briefly go over that a little bit more, that'd be great as well.
Yeah, and you can invest through an LLC. And so I think I would want to double check this, but I'm pretty sure as long as the principal members of the LLC are all accredited, you can't have a majority member of the LLC that's not accredited and still qualify. But if you are, then you're fine. And then, or if the LLC itself has a value of over 5 million, that would also qualify you. And yes, many people invest with their LLCs, especially, and also with their IRAs. Oh, and then monthly cash flow. So that, right. So this EDF's only been open a few months. And the way we do it is that every month we have the IRR projection. And so the first month, that is the projection of what the annual return will be based on the revenue from 1 month. The first month we did it, it was about 19%. The second month that we did it, it dipped a little bit. I think we were down to 14%. That was really because of we're transitioning the assets right now. So it's not completely solid. We're having to wait until we get fully funded. We get all of the assets moved over, and that's when it's going to be more like clockwork. The most recent one that we sent out was a little over 20. So we had anticipated with this one that it wouldn't be hitting our full annual 20% to 21% until March of 2023, and we're already exceeding that goal. So as far as the monthly cash flow, if you invest 100,000 and then we, consider it being 20,000 divided by 12, that's your monthly cash flow.
Perfect. Thanks for going over that. I'm not sure if this one is from Ron is a question or a statement. Do you see that one?
Yeah, mineral rights for oil and gas have no cost associated with them. They're completely passive. Yeah, I mean, that's accurate.
Perfect. So I think
there's multiple, there's some layers to that though. I mean, like there's working interest and there's NRI. I will, full disclosure right now, I am not the oil and gas expert here. I know a lot about it. But again, we have excellent team. Brett is available to answer any of your questions anytime. And JB as well. Like I said, we have a team of absolute powerhouse experts on all that stuff. So I'm not quite there yet, but I can certainly get you in touch with any of those people at any point.
Thanks again, Jamie. It looks like the questions are winding down. So I just want to reiterate that if any of you have any questions about what was discussed today, please use Jamie's contact information and reach out to Jamie or another member of ALG, and I'm sure they would be more than happy to help, like she just said. And if you have any questions about self-direction or how you can do this through your IRA, please feel free to contact me or Camaplan directly, and I'd be more than happy to help.
Great.
And thank you, Jamie.
Yeah, for sure. I guess I just want to leave on this thought too, that like, I appreciate you guys letting me talk about our company, but principally everything that I'm saying is very applicable. So I want you guys to have learned something today and not feel like I was just trying to sell you on us. I mean, obviously I love us, but principally all these things are very important. And even if you don't invest with us, we're not investment advisors here, but we're a great resource. And we certainly have a big value here of being helpful and informative. And we want what's best for everybody. So even if you're not accredited, maybe you know somebody that is, or if you're not and you want to still have some information, we're always still happy to talk to you. So just feel free to hit us up. And I would just thank everybody for their time today.
Perfect. Thank you. And I want to do the same and thank you, Jamie, and thank everybody for joining. I hope you all have a great rest of your day. This has been recorded and everybody you registered will receive a copy of the recording. Have a great rest of your day.